In the early days of cryptocurrency, when the market was still in its infancy, everyone was searching for a visionary leader, a genius who would lead the way. That visionary turned out to be Sam Bankman-Fried, commonly known as SBF. Sam was not your typical finance magnate. He came from a humble background and made his mark by founding and leading FTX, one of the most prominent cryptocurrency exchanges. FTX rapidly emerged from obscurity to dominate the crypto scene. In just a span of 3 years, it gained immense popularity, even securing endorsements from celebrities. Investors and traders flocked to FTX, heralding it as the safest and easiest platform to trade cryptocurrencies. It seemed like the crypto industry had finally found its chosen one. But beneath this veneer of success, darker secrets were lurking. At the core of this dramatic narrative is the intricate relationship between FTX and Alameda, two entities that were ostensibly separate but intrinsically linked. While FTX was the exchange that attracted traders, Alameda was a market maker and proprietary trading firm. These two companies, under Sam's leadership, shared more than just a symbiotic relationship. Alameda's influence was deeply woven into FTX's operations, and this synergy ultimately became a breeding ground for trouble. Allegations of misuse of funds were rife, and what appeared to be an unshakable empire was on the brink of collapse. To understand how Sam became the face of FTX, we need to delve into his backstory. Sam, the son of law professors, was far from a conventional finance guru. He had an impressive academic record, attending math camp, MIT, and briefly working at Jane Street, one of the world's largest market-making firms. However, his stay at Jane Street was short-lived, with Sam describing it as neutral but a waste of brainpower. He then ventured into the world of effective altruism, a philosophy advocating the efficient use of wealth to help those in need. It was during this period that the seeds of Alameda were sown, with the aim of applying traditional financial strategies to capitalize on the crypto market's potential. In 2017, Sam established Alameda Research, a market-making and trading firm. It began with just a handful of people, college roommates, and old friends of Sam from math camp. The key to Alameda's early success was the price disparities of cryptocurrencies across global exchanges. By exploiting these inefficiencies, they accumulated substantial wealth. However, even at this juncture, there were skeptics who questioned the risks they were taking. FTX, a recognizable name today, emerged as an offshoot of Alameda in 2019, featuring the same core team. It quickly gained mainstream recognition and set its sights on becoming the leading crypto exchange. The year 2021 marked a significant turning point for FTX and the broader crypto industry. Amid a surge in institutional interest in digital assets, FTX signed high-profile sponsorship deals with Mercedes Formula One, roped in endorsements from stars like Tom Brady and Gisele Bündchen, and cemented its presence in the mainstream. Sam Bankman-Fried, or SBF, was no less than a phenomenon, sharing the stage with prominent figures like Bill Clinton and Tony Blair. FTX was the benchmark for legitimacy in a crypto market filled with questionable entities. As FTX continued its meteoric rise, retail investors like Sunil Kavuri entrusted their funds to the exchange. Sunil had over $6 million invested in FTX by the end of 2021. FTX marketed itself as the safest gateway into the crypto world, convincing investors that their money was secure. They closed a funding round of $900 million in July 2021, valuing the company at an astonishing $18 billion. Within 2 years, FTX's valuation had soared to $32 billion, surpassing even Deutsche Bank's worth at the time. The intricate web of connections between FTX and Alameda started to unravel as allegations of improper fund usage and questionable relationships surfaced. The supposedly separate companies appeared to be anything but. They shared assets, with Alameda having significant holdings of FTX's native token, FTT, on its balance sheet. This revelation cast doubt on the supposed independence of Alameda and FTX, raising concerns about the legitimacy of the assets held by Alameda. In essence, tokens created by FTX appeared to have been conjured out of thin air. On November 2, 2022, CoinDesk published an investigative report raising questions about FTT, FTX's native token. The report shed light on the massive holdings of FTT by Alameda, highlighting their control over the supply and its value. This led to suspicions of misleading accounting practices and inflated assets. While many, including Sunil Kavuri, were initially unfazed by the report, A sense of foreboding began to creep in. FTX suspended withdrawals, a pivotal moment that signaled trouble brewing beneath the surface. Customers' confidence wavered as they were unable to access their funds, leading to growing uncertainty. FTX's financial instability sent shockwaves throughout the industry, reverberating far beyond its own ecosystem. Hedge funds, traders, and institutional investors began to raise concerns about their frozen funds, which were used as collateral in lending operations. The crisis escalated rapidly, and within a few days it became apparent that FTX was running out of money. This impending disaster sent a ripple effect across the crypto market. As the value of FTT tokens plummeted, people who had trusted FTX with their investments, like Sunil, found themselves facing substantial losses. In the midst of this growing turmoil, Sam Bankman-Fried embarked on a public apology tour. He was determined to reassure users that FTX was still a viable platform. Despite the looming insolvency, Sam continued to convey that everything was under control, even as mounting evidence suggested otherwise. The situation took a surreal turn when he announced his intention to buy FTX back from the brink, an offer that was met with disbelief. Customers who had lost millions were left wondering if there was any hope of recovering their funds. The collapse of FTX was swift and brutal. FTX filed for bankruptcy in New York, and Sam stepped down as CEO. This catastrophe left users like Sunil, who had entrusted millions to the exchange, reeling from their losses. As the days passed, it became apparent that an estimated $8 billion in customer funds had gone missing. Sam Bankman-Fried faced a barrage of legal actions, lawsuits, and regulatory scrutiny, with accusations ranging from mismanagement to negligence. Sam's fortunes continued to plummet, and he was arrested in the Bahamas on a U.S. warrant. The charges included securities fraud, wire fraud, and conspiracy to commit both, adding a new layer of complexity to an already bewildering situation. Sam's dramatic fall from grace and the legal consequences he faced left the crypto world in shock and disbelief. This tragic tale unveils significant gaps in oversight and governance within the crypto industry. The incestuous relationships between different entities, the lack of transparency, and the absence of robust regulatory frameworks were some of the critical factors that contributed to FTX's downfall. Investors had placed their faith in a rapidly growing empire, with little insight into the potential risks they faced. The aftermath of FTX's fall has left a lasting impact on the crypto world. Investors, both retail and institutional, have been forced to grapple with the reality of the situation and seek remedies for their losses. While some have initiated legal proceedings to recover their assets, others face the prospect of never seeing their funds again. FTX's collapse serves as a stark reminder of the need for regulatory oversight, transparency, and due diligence in the cryptocurrency space. As the crypto industry continues to evolve, it must adapt and establish systems that protect investors, prevent similar situations, and build trust in the market. The story of FTX and Sam Bankman-Fried is not just a tale of meteoric rise and catastrophic fall. It's a cautionary narrative for the entire crypto world. As we navigate the complex and dynamic landscape of cryptocurrencies, we must exercise caution, conduct thorough due diligence, and support efforts to introduce robust regulatory frameworks. Join us for more insights into the ever-changing world of finance and technology. Be sure to subscribe, like, and share this video for the latest updates. Thanks for watching, and stay tuned for more thought-provoking content from Money Hustler.